Hello and welcome to another in our series of educational videos with Elliot Omenson and
Nathaniel Vossman.
Today we're going to be talking about how to pay 0% capital gains tax in retirement.
Yeah, I think it's a pretty cool topic, and right in line with one of our favorite things: paying as little in tax as possible.
Absolutely, right. You have this line at the end that I really like, where you talk about how retirement isn't about how much you have; it's about how efficiently you use it. Right. So we're gonna circle back to that, but I think it's interesting that the minute we go into retirement, the amount of money we got is the amount of money we got.
Yep.
And there's a very famous quote along those lines. It's not how much you make, it's how much you keep.
Yep.
And I've always looked at it, a lot of times I look at, am I going to pursue doing something? And the way I look at it is, would my time be better spent by doing something else to make money? Or would my time be better spent trying to recover the lost money? And that's literally how I choose whether or not I'm going to spend any time trying to return a item that doesn't fit.
Yeah.
Or is wrong.
Exactly.
Or whatever. To me, it's just like, it's not worth the time to do it.
Yeah.
Right. But quite often with taxes, and I'm stealing from a podcast I was on, Brett Schwartz's Build It to Billions, promoting my book, Keep What You've Earned. But I always say that taxes is your single largest expense. And I'm actually switching that to his saying, which is what you don't know is your single largest expense.
That is true.
And taxes is your second. And the reason why is because quite often you're paying taxes because of what you don't know.
Exactly. Because I think there's a couple examples in what we're going to talk about today. It's like little things that could save you a lot of tax.
Yeah. Yeah. And so that's what we're trying to do with this educational thing is we're trying to make it to where you know what you need to know now. So you can keep what you've earned.
Yeah. Whether or not you're on your own or you got your own advisor,
yeah,
you can at least be bringing this up because I'm sure there's plenty of advisors out there that really don't even pay much attention to the whole tax side of things.
Yep. I don't think they do. So, what are we getting started off on here?
Well, we can start out at a high level like we usually do. So in this case, we're talking about capital gains. So you kind of want to dive into capital gains, how they're taxed, kind of difference between short-term and long-term.
Yeah, absolutely. So let's do it from the standpoint of what type of accounts you have, right? Now, technically, I get a little technical in this business because I think there's lots of liability, and so we kind of have to.
Fair.
You have two types of accounts, qualified and non-qualified. But within the qualified arena, you actually have two types of qualified accounts. And I don't know why they combine both of them, but what people think about is qualified, which just means qualified for tax deferral, usually. And so that's your IRAs, your 401ks, your 457s, all of that stuff, right? So you've taken money that's never been taxed, you've invested it, and you're getting to grow it. And when you take money out, every dollar of it is fully taxable as income, which also impacts Social Security and IRMA and a lot of other things. Now, technically, a Roth is also considered a qualified account. I might be wrong about that, but I'm pretty positive. But a Roth behaves the exact opposite. It's used after tax money, and your growth is never taxed. Okay? Now, the first one we talked about, your qualified account where it's deferred, your IRAs, 401ks, that's the bulk of most people's assets.
Yeah, definitely.
The Roth is the least amount of people's assets, and that's due to the income limits on contributions and the actual limit on how much you can put in every year. In the middle of these two, we have what's called a non-qualified account. Sometimes people refer to them as a brokerage account. Sometimes they'll be labeled as a joint account or labeled in the name of your living trust. If it's labeled as a joint, if it's labeled in the name of your living trust, I guarantee it's a non-qualified account. Within non-qualified accounts, you can accrue two types of, it's your principal was already taxed. So you'd earned money, it went to your bank account, you invested that money into a brokerage account or joint account or whatever. That's already been taxed, but all your growth is going to be taxed either as short-term or long-term capital gains. Now, one thing to note, I think, with these accounts is the point at which the taxable event occurs. So within a tax deferred account or within a Roth, I can buy and sell like I am a coked out day trader. Okay. All day long.
Oh, yeah.
There is no taxable event occurring, no matter how much I sell or buy inside of a IRA, 401k, Roth, all right, inside any kind of tax deferred or Roth account. With a non-qualified account, like a brokerage account, joint account, trust account, the taxable event occurs at the point of the sale of the asset inside the account. So one, it occurs when the money leaves the account. The other, it occurs when you sell something inside the account. And I think that's a really important thing to note.
Yeah, I think so too. I think some people who don't early on in their investing years might not know something like that. They start playing around with trading in a taxable account.
Oh yeah, I remember 20. I remember
the hard way. I know people have done that.
Yeah, yeah. Oh yeah, 20-something years ago, I was trying to do the whole day trading thing for fun while I was like in the military, and I, by the time I got done paying all my trade fees and taxes, let's just say don't do it.
You don't keep much. So that is an important thing to note.
Yeah, very, very important. All right. Now, short-term capital gains are fully taxed as income. All right. Now, one thing I want to mention before that. So when we're managing accounts and there is a significant market event, right? We might take steps to protect assets inside a qualified account, but we might not take those same steps in a non-qualified account. And so you really have to be careful, because you might go, hey, I want to protect this growth in this non-qualified account. So I sell all that and move it to bonds, and I just triggered a $130,000 capital gain, and I just burnt 37 or 35 or
you lose more money that way than what you would have lost in this like downturn.
Yeah. And technically it's not exactly losing it, right? Because you're gonna pay those capital gains at some point anyway. Eventually. You just might not have want to done them now.
Yeah, because then you got less money to grow off of in the meantime.
Yes. So just as food for thought there, right?
Yeah.
So short-term capital gains are fully taxed as income. And here's the other thing that sucks too, right? You could sell a position, realize a gain, move into another position, and lose more than what you gained. But you still owe taxes on your gain. If it crosses the year, right? You might get hit with this tax bill at the end of the year, and you don't even have the money.
Yep.
So
that's the tough part about it.
Yeah. You got to be careful. So a short-term capital gain is fully taxable as income. Now, long-term capital gains is where the magic's at, because they're taxed at 0, 15, or 20%, just based on your taxable income, not on the size of the portfolio, right? So that's one of the great things about being in retirement. And I'm going to let you. That was your line. I like the line, so you should jump in here. So, in retirement, what?
Well, it's not about how much you have; it's how efficiently you use it.
Well, yeah, but you put in here. You said you control income, you control the rate.
Yeah,
I thought that was excellent,
and that's exactly it. And it kind of ties into the whole idea of what you don't know is the biggest expense, because you have control over a lot of things. Whether you're using something like this or previous topics that we've talked about.
Yeah. And so what are the tax rates for 0, 15, and 20?
Yeah. And so on that last page, I do have the brackets.
Yeah, this is awesome.
Because in the notes here, I think it's pulling out the 2025 number.
Yeah.
But, you get a decent little cushion on, the 0% bracket. Like if you're married, up to 98,900 keeps you under at 0% on those capital gains.
Yeah.
Long-term capital gains. And so it's, if you ever have a year, maybe you're in between work, maybe you're recently retired, before you're having to start Social Security and RMDs, like it could be a pretty good time to sell off a couple positions that are pretty highly appreciated, because you can pay 0 capital gains on that potentially.
Yeah. And I'll tell you, there's a weird psychological thing that occurs. And we actually had a guy in here who bought, I don't know how much of NVIDIA at $5 a share. And now it's bouncing around 150, and he's got $3 million in it. he will not sell it.
He's got a whole bunch of it too.
Right. And I can't tell you how many people I see with significant assets and they just refuse to sell and pay the tax in order to use the money. Well, they may not. It's just like,
unless you want to be that concentrated.
I just don't. Yeah, to me, it's just like I don't understand like what the hang up is. Right.
At that point, you already won.
Yeah.
I guess I'd be more happy to
even
pay
after paying the tax. Look at what your net return is.
Yeah.
Right.
Crazy, yeah.
Yeah. So for married filing jointly, income up to $98,900 is taxed at 0%. From $98,900 to $613,700 is taxed at 15%. Now, for most people in retirement making around, taking $120,000 a year of income, their net effective tax rate, from what I've seen, is somewhere between 9 and 11%. So 15 is a little high, but still, it's way better than 20, right?
Yeah.
If you're single, it's 0% up to $49,450, and it's 15% from $49,450 to $545,500. That's really interesting that they cut the 98.5.
That's what I was thinking. It's like,
but then they only cut the 600 by
because in so many other instances,
$60,000 or something.
Single versus married, it's just like doubled. But
yeah.
That's one of the few instances where it's not at all. So that is pretty interesting.
Yeah. Yeah, but especially when you compare the capital gains rates to income rates, right? Because you're going to break 22% married filing jointly when your income goes over 211. But you don't break 20% until your until your income goes over 613.
Yeah.
So
a little more favorable.
Yeah, right? So just to close that section out with your line, your tax rate depends on your income, not how much your investments made. Right?
Exactly. So I guess we can kind of go into, and this, obviously depends on income levels, but, there is capital gains harvesting where you can sell off and appreciate assets and potentially rebuy, similar to,
you mean a depreciated asset or an appreciated asset?
So like in this case, appreciated, meaning like, so let's just say, for example, in that perfect gap year where you got no income, you could sell like up that $98,000 of appreciated asset, paid no tax on it, and if you wanted to just step up your cost basis, you could just buy it right back. There's no like wash sale rule like there is on a selling at a loss. But a strategy like that really only applies when you do have like a true like gap year, not much income. Because otherwise, if you're already in the 15% tax bracket, it's a little less attractive.
Yeah, I can honestly say I have very few. I can probably count them on one hand. Clients that are
it's more of a specific situation.
Taking less than 98,900, but there are. But I will tell you, sometimes if somebody retires early, we will structure their income in those early years for them to be able to qualify for the Affordable Care Act healthcare plan on the marketplace for no money out of their own pocket. And that's pretty, for a married couple, that's a pretty significant savings.
I'm sure it's huge.
And during that same period of time, you could balance some without messing with that too much. So you could use the same period of time to do something with cap gains as well if they have health insurance from somewhere else.
Yeah.
Either one would be a great time to do that in.
Yeah. And it's like maybe you could just utilize it a little bit. It's not like you gotta max it out and do the full.
Yeah, because any amount of this you're doing is a huge win.
Yeah. Because you're at that point you could potentially, if you have less than that $98,000 of income, then you almost might as well just do that. Because then you're effectively just.
Even 5, 10, 15, 20 grand of that.
Yeah.
Is awesome.
Otherwise, you could be paying like someone like NVIDIA where it's like almost exclusively gains.
Yeah.
You could take off some. Even if it's making a small dent, it's like you might as well.
Yeah, you might as, right?
Yeah, it's just free at that point.
Yeah, like you said, right? So you just keep your other ordinary income low using Roth withdrawals, cash, income timing, and that's all we were doing to get people to qualify for
Exactly.
the health care for nothing out of pocket,
Yeah,
right?
exactly.
You just pull, and normally you'd want to, under normal circumstances, your advisor is going to tell you to push those income sources till later in life, and that's the pat answer, and it's generally correct.
Generally correct,
until
yeah.
you apply a situation like this to it, which adds another level of nuance.
Yeah, and you get that extra value. So you're trading, waiting on pull income for those accounts, but the value you're getting out of it
Yeah,
makes it worth it.
absolutely.
And then on the flip side, something that's I would say probably more common is the tax loss harvesting.
Yes.
And so you're taking losses to potentially offset some gains or just reduce your taxable income in general. And this is another thing. It's like maybe it's like generally you don't want to be selling things at a loss, but there are good situations you could maybe want to take some money out of that investment in the first place, or if you're getting really bumped up to a higher tax bracket, it might be worth just selling off some of that stock at a loss and just deduct that straight from other gains that you've pulled out.
Yeah. Well, let me think of this, right? Because this is a little complicated, right? But you can own a ETF like the SPY, and that's going to cover the 502 positions of the S&P 500. But within that, in any given year, it's not all when the market goes up 15, 20%, it's not the whole market going up. It's usually there's more companies losing, usually.
Oh, definitely.
Fewer companies gaining, but those gain so much that it lifts the entire index.
Yeah.
So an alternative, and I don't personally do this, but an alternative would be don't own the index. Own as many of the individual positions as possible. And as the index is climbing, sell the ones that are losing to be capturing losses. And there's companies that specialize in that. But yeah, that was.
Hey, you got a tax loss harvest, and then at the same time, you save on like that little tiny expense ratio too.
Absolutely.
You save out. I think the SPY may have something like a 0.07 or something like that.
Yeah, yeah. It's not enough to worry
Save
about.
A few pennies.
But I do like the idea of doing that because it's. I mean, that within the S&P 500, within the DJ30, in fact, 2015 was the most perfect example ever. From January from the first half, from January to June, or the end of June, the DJ30 in 2015, 3 companies accounted for 100% of all growth. That was Disney, Cisco, and Caterpillar. And Caterpillar alone accounted for half of the entire growth of the Dow Jones Industrial 30.
Yeah, it is funny to think about that, especially when you look at the other indices that have so many companies in it, but they get to the Dow, and it's really not that many companies.
No.
That one company can really drive it.
Yeah.
But even the S&P 500, you got over 500 companies in there, and you get like something like NVIDIA that can really change the market cap.
Right? NVIDIA, Amazon, Netflix, Apple, Google, ones. Tesla.
And it's just funny, too, that recently now in the S&P 500, it's hitting all-time highs, even though a lot of those big companies are actually nowhere near their all-time highs.
Yep.
So it's like one of the few times that the rest of the index kind of pulling.
It's starting to help out. Yeah. Yep.
And then I guess we could briefly touch on, since we have been kind of talking about tax brackets, briefly just touch on the standard deduction and how that impacts gains.
Oh, yeah. This is really good to go over, right? Because where does the deduction come in when calculating your income?
Yeah, because that's just reducing your total taxable income.
Yeah, because it goes your ordinary income plus your capital gains, then minus your deductions.
Yeah.
Right? And so that standard deduction helps create room for more of your gains to fall into the 0% bracket.
Exactly. So even though it says 98, in reality it's more than that. By the time you factor that standard deduction in. But alternatively, you can itemize. So another cool option to avoid paying some capital gains is donating stock.
Oh, absolutely.
There's some that you you can't use standard deduction at this point. You'd have to itemize to get the deduction for donating. But I think it's a pretty cool way to make a donation because you can deduct the value of the stock that you're donating. So say you donate 100 grand of NVIDIA, you can deduct that whole amount and you're not paying capital gains on it. It's pretty cool use of your money.
Yeah. And so this goes to something that I want to touch on really quick, right? When we're doing webinars and stuff like that on taxation, one of the things that we stress is that the tax code is not a penalty box. It's a playbook.
Yep.
And everything in it is something that the government has decided they want you to do, and they're trying to incentivize you to do it. Now, there's always an effective and a less effective way to go about things. I think the less effective way would be go through the tax code and start doing things that is in the tax code in order to reduce your taxes. I think a much more effective thing to do would be look at what you're already doing and do it in the manner in which gets you the best tax outcome.
Yeah.
Right? So I would never tell somebody, hey, you know how to save $111,000 of your capital gains, go donate $111,000 of stock, right? Like, well, what was the point of that?
Yeah, if you're not already donating, then you are just losing that money. You know?
Yeah.
But if you're
and don't get me wrong, I would much rather you donate it to anyone other than give it to the government.
True.
I mean anything.
Yeah, anything.
Go find the most
I don't care what it is.
Benign, whatever that word is, charity, right?
Yeah.
You know, something trying to save the East African polka dotted snail, right? And give it to them.
Better than the federal government.
Yeah, I mean, they're just going to send it over there to something stupid anyways.
Yeah, exactly.
At least it goes straight to their hands and doesn't line a bunch of bureaucrats' pockets in the meantime. But if you're already making donations, your church, what's the people that run an ad every year at that female pop star where she sings a super sad song about animals?
Oh.
In the arms of an angel.
I have to change the channel anytime that comes on, dude. I can't watch that.
Yeah, but if you already donate to your local pet shelter, your church, whatever it happens to be, just send it directly to them. And this actually accomplishes, as you were talking about, right? It avoids the capital gains, allows you to deduct full market value. And that has limits, 30% of your income.
Yeah, 30% of your income. But it can carry forward.
Yeah.
If you do more than that.
But if you're if you're 73, 74, 75, or you turned 70 and a half back when RMDs were 70 and a half, and you're falling into the required minimum distributions, and you're already making donations to a charity, or you just happen to have in the last year or so decided to get a charitable heart and start making donations to a church or a charity, you can have your required minimum distribution sent directly to, and is it just required minimum distribution or is it any donation from an IRA?
I think you do beyond your RMD.
Yeah.
But definitely like your RMD, especially if you don't need that money in the first place, you might as well just donate it because otherwise you're going to take that money, get tax on it, and then you're going to make your donation anyways.
Yes. And so it's much more advantageous for you to just have it sent straight from your IRA to the charity. It never hits your income as taxes, and it fulfills your required minimum distribution.
Yeah, it's like several beautiful things. You don't pay tax on it. You're not getting bumped up in tax brackets. You effectively get to donate more money.
Yep.
And so there's no reason not to. If you're going to make a donation, you might as well be doing that. Or if you're not taking RMDs yet, just selling your stock, or not selling your stock, but donating your stock.
Yeah.
There's just no need to effectively take income, pay for it, pay the tax on it, and then go out and spend money on donation.
Yeah.
So.
Yep. Definitely not.
Let's see. So then, of course, if you're going to do the stock donation, you have to itemize. And then another thing that we have on here, which is not directly talking about capital gains tax, but important to note, is that state and local income tax.
Yeah, SALT.
Because that effectively, is a deduction, and so you can keep your income lower, and then maybe utilize stuff like this a little bit better. But with that one big beautiful bill, the state and local income tax deduction cap is now $40,000 as opposed to 10, and that's going to be going through the end of tax year of 2029. But as with other things, it could be extended.
Yeah.
But at least through 2029, that's a pretty big deduction you can take compared to 10,000, especially if you're in a state with higher state local taxes, like in California. Versus if you live somewhere like Texas or
just
Florida.
pull up an electoral map. If your state's blue,
yeah,
you probably have very high salt taxes.
Yeah, and then like I said, people like states like Texas, Florida, you're not gonna be hitting that.
No, especially since Texas and Florida are zero.
Yeah, well, you might have some local tax, but no state income tax.
Yeah.
Let's see here. I mean, that's a majority of what I've got to cover. Do you have?
Yeah, we kind of covered a lot of these things all throughout the whole deal, right?
Yeah. In general, do you think there's any notable mistakes that people make with planning? Whether it's just, I don't know, choosing the right time to sell stock at a gain or sell stock at a loss in terms of, how much tax they're paying on it?
Yeah, I mean, to be honest, I just think the biggest mistake people make is that there's like, who's doing it for you, right? Where are you going to go? So I told you just the other day, we were listening, we were on hold, right?
Oh, yeah.
With a large financial firm. I refer to them as Eduardo Jorge. You may be able to deduct who I'm talking about.
I think so.
But so we don't get sued, we won't put their yellow logo up. And the hold message was explicitly stating that your Eduardo Jorge advisor is not allowed to discuss taxes with you.
Crazy.
How?
Yeah, how do you have
Can I be your advisor and not be able to talk about taxes?
Makes no sense. Like, you have to bring in your CPA every time you meet with your advisor. And even then, how does the conversation work if the advisor can't even talk about tax? Like, I don't even know how the discussion works. And it's like such a huge portion of like your retirement and even pre-retirement is tax.
Yeah.
Like when we say it is like the number one or maybe number two expense, like we mean it.
Yeah.
And so the fact that your advisor wouldn't be allowed to talk to you about tax is mind-boggling.
Yeah.
And the fact that anyone would pay any kind of fee for that, I don't care how small that fee is, it just makes no sense to me.
Yeah, it reminds me of that quote from the 90s. I don't know if it was Bill Clinton or his advisor James Carville, who said, "It's the economy, stupid.
Yeah.
It's taxes, stupid."
It is. Exactly.
And there are, like, that one firm has 18,000 advisors, all of which are not allowed to discuss taxes with you.
Yeah.
And I assure you the rules apply to almost every other firm.
Yeah. And firms like that, not only do they have 18,000 advisors, but those advisors have a ton of clients too. They're more volume versus like a smaller firm. And so like millions of people are working with advisors like that. Millions of people are working with advisors that can't even discuss taxes. And it's like, no wonder people get so damn confused.
Yeah. And so I just think the number one absolute biggest mistake people make is in putting their team together, picking the type of advisor they have, right?
Yeah.
Does your CPA do anything other than take the documents you give him and tell you how much taxes you owe at the end of the year?
Most cases, no.
Are you willing to pay an advisor to build you a decades-long tax minimization plan, right? Because you can complain about your CPA doing nothing for you, but are you even willing to pay the guy if he was willing to?
Yeah.
Right? So, like, I think people have to absolutely make sure that the team they have is all-encompassing and compensated correctly.
Yeah.
So that they're incentivized, motivated, and are capable of hiring the people and paying for the right tools in order to like help you with this. Because it's like it doesn't take It doesn't take but one transaction to have generated thousands in taxes
Well, exactly.
that didn't need to happen.
Exactly. And it's like, it's because there's a difference between trying to be reasonable with costs, like with how much you want to pay someone to do something for you. But like, you have to factor in, especially with something like your own money in your retirement, is that every little mistake that you make will cost you so much money that, like, basically, there's a reason why advisors within these firms that we're talking about just really aren't a great fit, because you might be saving money on whatever fee that they're charging. It might be less than the next advisor, but the other advisor, like someone like us.
Yeah, we charge that we're probably the most expensive asset management fee in America.
But we also save people a ton of money on tax.
Yeah.
A ton of money on tax. And so it's like a huge net benefit to them versus going elsewhere where someone can't even discuss taxes with them.
And if we charge the fee everybody else does, I'd have to have the thousands of clients everybody else does, and guess what we wouldn't be doing?
We wouldn't be able to be doing this.
Yeah.
That's exactly it.
Yeah.
Exactly it.
So, are you telling me that saying you get what you pay for?
Yep, pretty much. Yep.
All right. Awesome. Well, what's our next topic up in the chute?
Oh, dude, we got a few. Let's see what's up. As usual, probably a lot to do with taxes. Let's see. I think we got some stuff about estate planning.
Awesome.
And then we also have, I think this one will be pretty interesting. We have one just about different types of investing. And so kind of comparing and contrasting, like investing for income versus investing for growth, and where it's appropriate to do either one. So I think that would be a fun one to do.
Yeah. Awesome. All right. Well, until next time, this is Elliot.
Nathaniel.
Signing off. See you guys.